Structuring your deal the right way can save you literally hundreds of thousands of dollars in taxes, and it comes down to one key decision that you make during the acquisition. That key decision is, are you buying this business in a stock sale or an asset sale? The problem is when you buy a business in a stock sale, you're going to be inheriting the basis in the assets of that company from the seller. What that means is, let's say a seller had purchased equipment in their business for $500,000 and they had taken depreciation on that equipment, and now there's $0 left in the basis of that equipment. But now you come in and you buy that business in a stock sale, you're inheriting that same situation. You're gonna have no depreciation going forward, which means you don't have that extra write-off against your income to save on taxes. Now in the alternate situation, if you're buying that same business at an asset sale, let's say that equipment still had a fair market value of, say, $300,000. You're gonna then now get a stepped up basis in that equipment to a $300,000 basis, and then be able to depreciate that equipment, saving you a ton of money in taxes, especially in the first couple years of ownership. On top of that, let's say you're buying the whole company for $1 million, and only $300,000 of that purchase price is getting allocated to that equipment. The remainder of that purchase price is gonna get allocated to goodwill, and that's gonna be amortized over 15 years. Again, continuously saving you taxes. So let's break that down further and talk about how it actually works. So the IRS uses what's called the residual method. And the way it's laid out is there's 7 classes of assets, and you need to allocate the purchase price of your business to each of those 7 classes, starting with 1 and ending with 7. The first class of assets is cash and deposits. Now, a lot of small business transactions are gonna be cash-free, debt-free, so there'll be nothing in this bucket. But occasionally, maybe if there's a working capital true-up, the seller might be leaving you some cash in the deal. Class number 2 is going to be actively traded securities. This is going to be another one that's very rare in small business transactions. So there's going to be anything allocated, because usually the seller is going to keep any stocks if they did happen to invest in stocks through their business. Class number 3 is going to be debt instruments and accounts receivable. This is one that you will see show up quite frequently if the seller is going to be leaving you some working capital in the deal in the form of accounts receivable. The dollar amount in this class is just going to be equal to the amount of the accounts receivable that the seller is leaving you. And so you might discount it if there's some uncollectible accounts receivable, but in a lot of cases, assuming everything's collectible, it's just going to be the value of those collectible invoices. The 4th class of assets is inventory. When you're valuing inventory, you want to make sure that you're not including the value for any obsolete inventory or any inventory that's damaged or just not going to be any use for you. Class number 5 is going to be your fixed assets. This is going to be things like vehicles and equipment. In order to value this, you're going to want to look at comparables. So if you're purchasing a business that maybe has 15 vehicles, you might go and grab the mileage logs for those vehicles, the age of those vehicles, the trim and make and model, and go on Kelley Blue Book or see what similar vehicles are selling for, and use that to drive the value that you're assigning to those vehicles. Finally, you have classes 6 and 7. These are going to be your intangible assets. Things like customer lists, trademarks, patents, and finally, anything that's left over will end up going to goodwill. Next, let's talk about the tax implications of assets getting valued into each of those 7 categories. To understand this, first you want to think about, how does this allocation affect the seller's decision making? From the seller's point of view, they want to pay as little in taxes as possible on the sale of their business. Now, if they were to have sold their business in a straight stock sale, they're going to have their entire purchase price taxed at capital gains rate, which is a preferred tax rate. If the seller had sold their business in a stock sale, they're going to be taxed on the sale of that business at their capital gains rate of 20%. However, when they sell their business in an asset sale, there's going to be a portion of the sale of that business that's going to be taxed at their capital gains tax rate, and another portion that's going to be taxed at their ordinary income tax rate, which can be 37%. When selling their business, the categories that the seller is worried about potentially paying ordinary income taxes on are going to be their accounts receivable, their inventory, their fixed assets, and then any intangible assets that they created themselves, such as the non-compete agreement is usually going to be taxed at their ordinary income tax rate. Then anything that wasn't allocated to those assets is going to be allocated to goodwill, and the seller is going to pay capital gains tax on that. From the buyer's perspective, everything that the seller wants, the buyer wants the opposite. They want as much allocated as possible to those fixed assets because they're going to be able to write off those assets a lot faster, versus goodwill, they're going to have to amortize over 15 years and it's going to take them a lot longer in order to take that deduction. And since $1 today is worth more than $1 tomorrow, it's very beneficial if the buyer can get more of the purchase price allocation to things like fixed assets. To illustrate this, let's walk through a quick example. Let's say a seller is selling their business for $1 million, and you as a buyer are trying to determine, one, should you purchase this business in a stock sale or should you buy it in an asset sale? If you were to buy that $1 million business in a stock sale and the seller had taken depreciation on all of their equipment and so there was no depreciation left, if you stepped into that company, you would also be stepping into the situation that the seller had where there's no depreciation left in that company. On the seller side, if they were to sell that $1 million business in a stock sale, they're going to sell it for $1 million and pay capital gains tax on the sale of that business at 20% federally. On the flip side, if you agree with the seller to sell the business in an asset sale, you and the seller are going to come to terms on how should that $1 million be broken down between the 7 classes of assets that we spoke about earlier. To keep it simple, let's say in this example, the fair market value of the equipment and vehicles is $300,000. That's going to be $300,000 allocated to class 5. And then the rest of the purchase price is getting allocated to class 7, which would be goodwill. On the buy side, that $300,000 that you're able to get allocated to fixed assets is going to be a huge advantage to you, because under the current tax law with bonus depreciation, you're going to be able to write off that full $300,000 in year 1, which is going to probably wipe out your entire tax bill for that year and potentially even the year after that. On top of that, you're still going to have the $700,000 that was allocated to goodwill. You're going to take that $700,000, divide it by 15 years, and you're going to continue to amortize that over the next 15 years. From the seller's perspective, when he sells that business in that same allocation, he's going to have to pay his ordinary income tax rate at 37% on that $300,000, and he's going to pay capital gains tax on that additional $700,000 that got allocated to goodwill. You can see how this creates a dynamic where the buyer and seller have opposing interests, because the seller wants more of the purchase price allocated to that goodwill. And so they might be trying to argue that the fixed assets are actually only worth $280,000, while you as the buyer have the opposite incentive and might be trying to argue that the fixed assets have a fair market value of $320,000. You can see how this can have a huge implication for both the buyer and the seller, and it can be a very important part of your negotiation, and it's a really good idea to have good advisors in your corner, whether you're the seller of the business or the buyer of the business. Once you do come into an agreement as buyer and seller on what the allocation will be, make sure that allocation is listed in your asset purchase agreement, because you and the seller are going to file a tax return that shows the allocation, and you have to make sure they both match each other. If you're working on buying or selling a small business and you need some help with your asset allocation, reach out to me. My name is Chris Barrett. I own and operate Midwest CPA. We help you avoid buying the wrong company and then successfully grow the right one.